Hello everyone, I hope everybody's had a good new year. This is the Fund Inspector. It's a relatively new channel. It's going to be talking about fund reviews, and it's also going to be managing my own portfolio. More of that to come tomorrow. I hope everybody's not too hungover when they're listening and they can pay attention, and hopefully this content will bring a smile to your face. Just a disclaimer alert, this isn't financial advice. It's just purely for entertainment purposes. I'd also like to say that I'm relatively new to the YouTube game, so the first couple of videos might be a bit ropey. However, I hope over time the content will improve and also the quality will improve. Also, I'm going to be travelling, and this is the main reason why I set the channel up, just for a bit of something to do when I'm on long buses, using dodgy VPNs and having to locate McDonald's just to use their Wi-Fi. Well, this was something I used to do previously as a job. I used to review investment funds, so I'd like to think I've got a little bit of experience in it. However, always make your own decisions, do your own due diligence, and do not rely on other people when it comes to finance and investments. Right, enough of all that nonsense. I think you've heard enough of that, and let's just get to it. Let's just talk investments, baby. The first fund that I'm going to review is no other than the UK's largest fund by AUM. So also during these videos I'm going to try and keep everything as simple as possible. It is mainly going to be people who haven't been involved in the world of finance. There's a couple of finance professionals who probably understand a lot of the terminology and may ask for additional analysis. However, I don't want to confuse people, and when I've talked about AUM there, I'm talking about assets under management. So that is essentially the size of the fund. So Fundsmith Equity, Mr. Terry Smith, he's a well-known fund manager. We're going to look at the retail share classes. There's institutional class, which would mean that institutions like your big massive companies are going to get slight discount on the charges just because of the economies that they can bring and the amount of money that they can invest compared to the retail. Right, for any fund we need to have a ratings card. So as we can see here, I've got a sort of Christmas theme for this rating card. So if I think something's excellent, I'm going to give it a Santa Claus and Christmas rating. Everybody over the festive period, I hope you had a lovely time. Hope you enjoyed spending it with friends and family, and I hope you also believe that justifies an excellent rating, because it is an excellent time of year for everybody. Good rating. Now, I had too many of these over the Christmas break, was pints of San Miguel. I think it's an underrated pint. It's nice and smooth, always in one of the glasses that you can see on screen, and it's never flat. What a pint. Right, okay, this might get a few boos from the audience and a few people shaking their heads at home watching in their beds at night. However, I'm not that big a fan of Christmas dinner. I think it's overrated. It's okay, it's not that bad, but for me, I don't think you would eat it any other night of the week, so it's got to be an okay rating. A bad rating, another overrated piece of Christmas food, it's mince pies. It's not even got mince in them. That's enough said on that. And terrible. Maybe not so much myself. Hangovers were okay this year. However, for anyone who's experienced it, there's nothing worse than waking up over the Christmas holidays with a pounding headache, and I think that picture of the guy sums it up. So they're the ratings. Let's just talk the ratings card. Let's just talk through the costs of the fund. So, like I said, we're going to try and focus here on our retail. So basically, John Smith, Joe Blogs on the street, instead of the institutions like your Black Rocks, etc., or any sort of big finance company. So the retail share classes get 1.04% charge on him when you buy every year. Okay, so it may not seem a lot, but over say 5 years, that's roughly 5% coming off your performance. And the institutional class isn't too much better. I just thought I'd add that in for a little bit of context. So the size of the fund in 2024 was £23.3 billion. Yes, £23.3 billion Mr. Smith is managing. And it's pretty much stayed consistent over the last couple of years, right? So I've just tried to put it into a little bit of context of how much money Fundsmith's making. So Fundsmith, for managing this one fund, is making roughly £240 million a year, right? So most of that will go to the fund manager. So Mr. Smith, he's got countless Ferraris, must have countless homes, and he's not short of a few quid, put it that way. Now, let's see if these fees and the fees that Mr. Smith gets can be justified from his performance. This is an actively managed fund, so this means that Terry will be going in and picking stocks that he believes can outperform passive indices. So you're probably wondering what's the difference between active and passive. A passive is just an index, such as the S&P 500 or the MSCI World. These are not getting picked from fund managers. Fund managers should be going in actively choosing stocks that they believe that anyone paying for can outperform these indexes that cost basically next to nothing. So the 1 year performance, the benchmark for this fund actually is called the IA Global. So that's the Investment Association Global. So essentially what that is, it's a peer group of other actively managed funds. So it's just a peer group comparison of other similar mandates that other fund managers use. It doesn't include passive funds. So although it's not in the prospectus and it's not something that Terry will say that you should be looking to, I think a more realistic benchmark for this is the MSCI World, because that's a passive index, and that's what active managers should be actively trying to do, is outperform the index. Whereas in a peer group, you could be the top of the peer group, but everybody else in that peer group is absolutely rubbish. On the other hand, you could argue that you've done well and other people have just done exceptionally well. But in this case, you'll find out that compared to the passive side of things, the active sort of IA sector's not done as well. There is an argument in finance about passives versus active. I don't think there's anything wrong with either of them. Most people say passives normally outperform the active funds. However, let's be honest, for somebody who is starting up a fund inspector channel and needs a little bit of content, I'm all for the active element. Right, over the 1 year, it's underperformed. It's underperformed the IA Global. It's underperformed the market index by quite a bit here. So it's got to be bad. It's got to be in mince pies for this, so it's got to be a number 4 rating. And look at that. I forgot to actually look at the ratings on forgot to do the ratings and the costs here. I told you I'm relatively new to the YouTube game, so just bear with me. I'll go back and do the costs. So this 1.04 for this side of fund is expensive. Financial Times, their sort of independent analysis, and so does Morningstar's analysis, both agree with me here. This is an expensive fund for the size of it. You would like to think the economies of scale from this fund and would make it an OCF of probably a lot less than that. So I think it's bad. It's high charges. It's not terrible. If it was up at roughly maybe 150. 1.50, I would probably give it a terrible rating, a holiday hangover, shall we say. But we'll just give it a mince pie. Performance over 1 year has been poor. Medium term, the performance has been really poor as well. It gets stung in 2022 with inflation, and it's not been great. Borderline terrible. However, I'm feeling generous because it's the new year, so I'm going to give it a bad rating. And over the 5 year tenure against its benchmark, it's outperformed. Over the IA Global, it's done 53%. However, like I said, I focus more on what we call the indices. It's done 80%, that's done 53. Like again, I would give this a bad rating, but I'm going to give it an okay because I'm feeling generous, and because it's outperforming its benchmark, Terry will probably say there's something wrong with this MSCI World and it's why it shouldn't be used. However, I'm sticking to my guns. I'm using the MSCI World. So what is important to mention is I've done up to 5 years, right? And the reason for that is a lot of these fund managers will come out and say, oh yeah, but since inception back in 1998, our fund's done really well. Okay, most people who are probably buying into these funds weren't even born then. And it's like anything, things can lose, people can lose their ability over time. I always think of football managers. Jose Mourinho was a brilliant manager, probably the best manager back in 2010. He's probably not even in the top maybe 5 or 10 managers in the world now. So things change, and although over 10 years the fund has done pretty well, I think I've got to make it a more realistic time frame of when people are buying into the fund. If you bought into this fund 5 years ago, I think that's long enough to determine how well you think they're performing. Right, and my favourite part is going through some of the weightings, and some of the holdings. I'm not going to do all of these. I'm going to give each one a rating, and I'm going to put NA to the ones that I'm not 100% sure on. There's a couple in there that I probably wouldn't buy because I'm not 100% certain on them. First one, right, Novo Nordisk. So a lot of people watching the channel will not know who Novo Nordisk are. Now let's get on to them. The reason you might not know who they are is because they were a relatively small Danish pharmaceutical company. Now the reason why this has exploded really is because they basically own the right to, some of you might have heard the drug Ozempic. Ozempic was a diabetes drug, but it's now being used as a weight loss drug. Now, as you can see here, over the past 5 years, it's went up 200%. Over the past year, I'll explain why it's went down in a minute. But Terry did buy into this a while ago, so he's not been hit, and what we're going to see here in a minute is this short-term underperformance. You can see here that the market cap is valued at 289 billion. We can see that price over earnings 29 is okay for a pharmaceutical fund, and that beta figure looks unreliable, so I'm not going to pay too much attention on that. What I would say is over the past month or so, 6 months, we can see that it's dropped about 40%. Now, this is like all pharma companies, especially with one that's Novo Nordisk, where they've really got the one major sort of product at the moment, which is Ozempic, is that any sort of legal challenge, any sort of drug trial that produces bad results, the stock normally takes a bad hit. Now Ozempic did get produce poor data on a recent trial, and that's why it's dropped roughly 40%. There's also the argument to say that when it was up at 142, it was maybe slightly overvalued because the price earnings ratio would have been higher than that. It would have been up at maybe like 50 or something like that. And there is an argument. So the question is, well, would I buy Novo Nordisk? Well, they've got the patent, I think, for until 2033, so no other company can really do much until that patent expires. The question is the next phase of trials, is this going to take off? Well, it's already valued at 290 billion, so can this hit, say 600 billion, like to get to double your money? I'm not so sure on that, but to be honest, I'm on the fence in this Novo Nordisk. I would probably put a slight weighting into the portfolio. I certainly wouldn't be running it at roughly 10%, but like I said, Terry got this out a long time ago before it dropped. So my own personal rating for Novo Nordisk is going to be, yeah, it's okay. It's the Christmas dinner. It's I'm not a big fan of pharma companies because they can be risky. I'd rather buy a sort of healthcare sort of ETF or something because just one sort of bad thing, for example, if somebody starts getting side effects of that they weren't expecting on Ozempic, then it's going to be a case of, well, there could be potential lawsuits. So for me, no, not at the moment, but I'm not against it. Next one, everybody's favourite stock, Microsoft. That is I'm not going to even do a review on that because most people have reviewed. It's an excellent stock, and there's two stocks in the world that somebody was to say just put all your money in and you leave it for 5 or 10 years. It would be Microsoft, and it would also be Alphabet, which is also known as Google. Meta, good stock as well, excellent stock. The value, I'm not going to go through this one again. It's up about, I think it's about $600 at the moment. I think that's also going to grow. I'm not as strong a believer in Meta as I am in Microsoft, so for that reason I'm going to give it a 2. I'm going to give it a San Miguel, a good old pint of San Miguel. L'Oreal, solid stock. It's relatively stable in earnings. It's not a big sort of growth name. It's pretty much a solid stock, and a lot of these ones that Terry has are pretty solid, in the sense that the earnings on L'Oreal are pretty good, and the valuation's not too bad. So I'm gonna give that an okay rating. I would add it to my portfolio, but I don't think it's going to get super gains. It's just a solid stock. Stryker, right? This is the one I'm going to do a review on. This for me is it's a potential 1, but I'm going to give it a 2, and I'll tell you why. Oh, that's came up. Stryker. So let's just have a look at the chart on this. You can see it's been a pretty good one, 72% over the 5 years. It's valued at $137 billion. It's got a beta of less than 0.92. So to explain, some of these terminologies, the market cap is essentially the value of the company. So it's valued at $137 billion. I think that's in dollars. The beta is the way that a stock fluctuates with the market. So it's almost like the volatility. So the higher the beta figure, the more ups and downs you're going to get, and it's going to be more of a roller coaster. Whereas the beta at 1 should move in line with the market. Anything below 1 generally would mean that it's a little bit less. It's a little bit less than the market's swings. So this year is like looking that it's pretty stable. It's not swinging as much as if I was to put in, for example, MicroStrategy or Coinbase. I think their betas are up at like 4. So the price to earnings ratio, again, I should explain this earlier on what I was talking about. This is one of the most important ratios. I think it's probably the most important because it is the price of the stock over the earnings. This essentially means that this is trading at 38.59 over earnings. Now, people would say that a good indicator of earnings, and it depends on the industry. So you're going to expect a lot of the tech names, a lot of the sort of to be higher earnings because higher price to earning ratios, because a lot of their valuations are built into the future growth, which they've probably not achieved yet in earnings. However, there's a growth potential for them to really exceed that. Whereas, for example, a paper company that can't really grow much, that kind of always churns out the same financials every year, there's not really much fluctuations. There's nothing wrong with that. Solid company, solid earnings. You'd expect to see the price earning ratio a lot lower than a tech company. It would be down at like 7 or 8. Whereas some tech companies like Tesla are up at 100 over earnings, which I'll review a fund next week that is basically a tech fund, and we'll talk through some of the valuations, which personally I think some of them are a bit overvalued. But in this case here, 38.59, some people might say this is a bit overvalued. It's a medicine company, Stryker. They basically make like the pharmaceutical prosthetic legs. and they're big in the med service. I was actually in hospital a week or two ago, and I actually noticed that the bed that I was in, the hospital bed, and all the others in the ward were all Stryker beds. So they've got a lot invested in healthcare, a lot of innovations in healthcare to make patients have better outcomes. It's not so much on the pharma side where I was saying there you got like the trials and the potential lawsuits. It's more on physical products, and I really like Stryker. The the sort of fake legs, etc., are getting, you can see them just in the street, etc. A lot more people are getting them, and they're becoming a lot more advanced. So, and they're also getting a lot more investment from a lot of the sort of government health boards like NHS. So I think this is a solid one. Right, it might be slightly at 38.59, but this is kind of a tech company with growth potential. I like it. I'm definitely going to be adding it to my portfolio. You can look at analyst ratings here as well. I don't really bother about analyst ratings, to be honest, but it's got like 406, so saying something value, but that's fine. So I'm giving that a 2. Visa's a 2. Philip Morris is a 2. So LVMH, I'm going to do a review on this. LVMH, Louis Vuitton, Moet Hennessy. So this here over the 5 years has been okay, 53%. It's got a big valuation, 317 billion. The beta's bang on 1. Price to earning ratio 22. So I think this is quite a nice valuation, because Louis Vuitton, Moet Hennessy, basically a lot of their growth is from acquiring companies. If you look at the umbrella of the portfolio of what LVMH actually own, it's quite staggering. They basically own every luxurious brand you can think of, and that's not even a joke. If you go onto their website, you'll be able to see what they own. They own everything that you would get in a top end establishment, and I'm talking about clothes, talking about whiskey, talking about brandy, obviously with Hennessy, you name it, women's fashion, everything. They've got a massive umbrella of very expensive assets, a very luxurious brand, underneath them. I like it. It's dropped a bit over the past year. Could be a buying opportunity, hopefully, and that will do with that. So I'm going to give that 2. IDEX Labs, I don't know enough about, and then automatic data processing, don't know about. Overall fund rating, okay, right. So let's summarise up here. The costs for a retail fund are a little bit high. It's performed well over 5 years against its benchmark, but not against the index, so it's been okay. Over 10 years, I'm not doing it. It has been quite a good performer. I still do have faith in Terry Smith. I think he is a good fund manager, very good fund manager, in fact. And although he probably himself, the 1 and 3 year figures are not great, I still have faith in the long term that he's a good manager, and I would buy this fund. I do like a lot of the underlying positions. There's not that many in there that I don't like, so that's a good sign. So overall fund rating, I'm feeling generous. I'm going to give it an okay rating. It's solid. I would add it into my portfolio. I think, that's when it is a get it off percentage. It's a 3. Okay, and I do like it. I'm going to give it a percentage of the portfolio. I'm going to give it as a weighting of maybe 6, and I'll give it 7% of the portfolio. Okay, everyone, let's wrap it up there. I've been the Fund Inspector. This has been the Fundsmith Equity Review. I hope you enjoyed it. Remember, keep talking investments, baby. And everyone, I hope you have a great start to the new year.